Oh. Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with our resident coal expert, Matt Warder of Seawolf Research. Matt, thank you for coming back on the show.
Steve, happy to do it. I'd do this every day if I could, but once a quarter is probably pretty reasonable.
Yeah. Right on. Well, let's see. Last time we saw you was out at the Rule Symposium. So yeah, I suppose about once a quarter is about where we're at. What is your macro view of the coal market today?
Okay, well, building on the last time that we spoke, whereas last year was sort of characterized by we expected seasonal demand to decline into Q2, and then we expected it to rebound in Q3, and it did not so much rebound in Q3. That was primarily driven by the Chinese economy faltering. And so the weakness that, most analysts kind of saw happening in 2025 leading into 2026 got pulled forward a little bit because, at least on the Met side, post-Indian elections, demand was not as robust as we expected it to be. And Chinese buyers were nowhere in the market, and they had steel inventories that were the highest levels since the last Steelmageddon that we had back in 2014, 2015 that led into the commodities collapse, which eventually bottomed in February of 2016. And so now we're through the hardest part of that, which has been borne out by prices and share prices for all the coal equities. So we're starting to bottom out. And here over the next, call it 6 to 12 months, we're going to be in search of what the reasonable bottom is going to be. Prices can't get so low that they cut out so much supply that we won't be able to uh, it, you know address demand in the future. But they have to get to a point where at least some supply gets rationalized, or maybe growth plans don't quite come to fruition for some of the suppliers that we always knew were going to be coming into the market here in 2025. So that's sort of the macro backdrop. We have the weakness that got pulled forward into 2024, trying to find a bottom, and now we have to see how individual supplies shake out throughout all the markets.
Okay, so nobody saw China injecting stimulus into their economy. Basically, a lot of weakness there with China. What is the supply demand models right now for thermal and for met?
I mean, on the weakness is really coming from the Met side. China continues to puke out massive amounts of steel into the market, and their domestic prices are just in the toilet. So they can't afford to import higher priced coking coal at the moment. They're trying to find tons that are less expensive, be that second tier coking coals, semi-soft, inject as much PCI as they can, anything to alleviate the cost of coke making. And to some extent, that has started to bleed over into the thermal coal market as well. We've had over the past few months a real downturn in Newcastle prices, where we went from about $140 a ton to about 111. At least part of that is semi-soft tons that are being resold by end users who purchase them as metallurgical coal cargoes, and then are having to sell them off to right size their inventories into thermal coal markets. That's something that you typically see happen at bottoms. So, in my view, that's kind of healthy activity to see those demands largely shake out. But as to whether or not, that behavior continues at the same level, I think that's what we're looking for to change over the next 6 months, whether that is some sort of rationalization of Chinese steel capacity, some sort of slowdown in exports, or trade cases that are currently being brought against China for dumping steel on the market to eventually take hold. In 2014 to 2016, that took about 18 months to resolve. We're about 6 to 9 months into that process. So I would expect, Q3, Q4, we should start to see some sort of normalization of that market. And we all have to keep in mind that even though, China's economy is slowing down, to the extent that we have any sort of trade resolution between between Xi and incoming President Trump, that's actually helpful for them in the long run. So there's a lot of uncertainty with regard to the geopolitical realm, and there's still a bit of uncertainty as to how China itself resolves over the next 6 to 9 months, and that's sort of what we're dealing with on the forecasting side.
Okay, I recently talked to Warren Irwin. Are you familiar with Warren?
Oh yeah, I met Warren a couple of times.
Okay, yeah, I met him recently out at the VRIC. I interviewed him. That interview will be coming out soon. And he was really bullish on the Metcol side, and his reasoning was India. Do you have any insights into that?
Yeah, well, that's really where the demand is going to come from over the next decade, right? As China slows down, I think back in when I was on the Wood Mackenzie Steel team in 2013, 2014, right when we started to forecast, we were calling for peak hot metal in China to be right around now, 2023, 2024, and here we are. So that writing's been on the wall for a while. It's not exactly a shocker that it happened. What was a little bit of a shocker is that we didn't get that seasonality last year. Usually, regardless of however their economy's doing, people still come in to restock. But the fact that they can't place those downstream steel tons domestically due to the weakness in the property market for, by and large, because property isn't just, demand for rebar and those sorts of things. It's also appliances, white goods, and those kinds of things, which are, 15, 20% of steel consumption in China. So as the property market goes, kind of so goes the steel side, at least for the time being. So that's part of the reason why stimulus measures haven't really helped, right? They've helped generate goodwill amongst the traders. They haven't necessarily generated the stimulus hasn't necessarily generated good results in the physical world yet.
Yeah, printing currency doesn't do anything for that.
I mean, again, that Warren's right that the growth in India will largely offset that decline in China, and as a result, like the met coal demand will sort of be flat to kind of increasing over the next 10 years, 15 years. But the difficulty is after this round of supply that we're going to see here over the course of this year and next year, which we'll talk about in a minute. There's really not a whole lot of additional production that comes online over that time. So as long as India grows, and as long as China's decline is manageable, and those two offset one another, I share Warren's view that we're pretty bullish met coal in the long term.
Okay, all right. So generally speaking, last time we saw this market was kind of around 2012 to 2014. It took about a year and a half. We're a third to halfway through that right now, as you see it.
Yeah, I gave a talk last summer down in Myrtle Beach where we talked about this exact thing. Like, if that seasonal demand doesn't really materialize, then we know that we're 3 or 4 months into at that time, a longer cycle that'll take a couple of years to play out. So,
Okay.
yeah, we're further on down the road. The longer this lasts, then the more either supplier will rationalize or the trade cases will take hold or something. But we should see a meaningful inflection by the time we get to 2027.
Okay. All righty. Have you seen the recent news? Well, it's scuttlebutt. I'm not going to call it news about Glencore and Rio Tinto as a possible merger.
Yeah, I have. I mean, obviously the get there is copper. That's really what everybody's after. But it allows Glencore the opportunity to spin off the coal company into a pretty massive shareholder return driven vehicle should they choose to do so. Now, whether that happens would be right now would be speculative because for them ideally they'd prefer to use that cash flow to develop copper assets or develop other projects that they may have, but we'll see how that goes. I mean, that's a Glencore merger with one of the other majors has been kind of bandied about for a good long while, and so far they really just kind of picked up the tech coal assets and not a whole lot else. So it wouldn't surprise me to see something get done along those lines. BHP made the overture for Anglo, which of course when we were hanging out in New Orleans wound up in the hands of Peabody, which has been death to those shares for the last couple of months. But something like that on the major merger side is bound to happen, I think, over the next couple of years or so.
How would you play that? Would you do like a long dated call option on Glencore or just buy Glencore shares I mean, we're just buying a rumor at this point, huh?
Yeah, I mean that's the thing. I mean, Glencore's stock price kind of performs alongside copper, the beta of copper prices. So, if we're in a part of the cycle where you're bullish copper prices, it's fine to own Glencore. Tech has done the same thing forever, regardless of how much money they made on the coking coal side. They just traded alongside copper. Rio Tinto I've never actually held. It's one of the few majors that I haven't owned at any one point in time. So I'm not quite as intimately familiar with its price cycle, but I would venture to guess that it shows similar dynamics as well. So, for me, it's owning Glencore is a derivative of copper. Later on, I think as we get into the end of the decade, and they actually finish the transaction of absorbing Tech's Elk Valley Resources operations, then all of that cash flow can be put to work in some way, shape, or form, to which we don't quite know what that's going to be yet. But it's interesting to hold over a long period of time. Just a question of like how well it behaves from a cyclical basis as to whether or not it's super advantageous to hold it over the entirety, or alternately to move in and out of it.
Okay. Piggybacking on Glencore, Lazar wants to know just about Glencore. Any updates? Does he see the upside being the dividends for the long run? I know he buys it each month without fail, so would like to know what his general long-term thesis is.
I mean, yeah, Glencore's one of those companies that, well, we know they're going to make money. So, it's just a question of, how do they return that to shareholders? And again, my experience with Glencore is that it just mostly trades alongside copper beta. So, it's one that I usually own when copper's on an upswing. I haven't done any work on copper here in 3 months, so I'm not quite as in tune with that as I am the coal side right now. But that's kind of how I think about it for the short term. For, as we get into 2027, 2028, when the Tech merger is complete and there's no further obligations necessary to them, then that is just going to be that free cash flow is going to look like a pig going through a python. And that's going to go somewhere, whether that goes to shareholder returns or to, further building the empire, I suppose is yet to be seen. If Gary is serious about, getting the message that coal is persona non grata, it should go back to shareholders.
Okay. All right. Okay. I thought this was an interesting question. Ashley wants to know, what other coal experts do you admire?
Well, I mean, I came up in a group of people at Wood Mackenzie who were all just really fantastic in their own right. So my boss that hired me was a gentleman named Jim Truman, who had basically been the man for Central Appalachia for a good 10 years prior to my coming online. And most of what I know about the U.S. Metcol industry was a function of what Jim was able to convey to me personally. I worked with him, right next to him every day for 4 years before I moved out here to Annapolis in the what wound up being the Wood Mac corporate office. We were like a little small, like boutique advisory company beforehand. Um, and then really after that, the guys who taught me more about the industry than anybody else really wound up being clients. Dan Horn in particular from Alpha Metallurgical Resources. I mean, I've probably learned more about the global met coal business from Dan than from any one human being. Him and Jim were like my two mentors with regard to like how to think about the market. And then when I vertically integrated in my career up to iron ore and steel, also to have a think about how end users, steel procurement officers, uh, how they purchase coal and how they manage those relationships as human relationships with sales staff at coal companies. And then, as you get a little bit further into it, you never learn the details behind the contracts because those are private and never come out in the public. But you do learn that the relationships between the salesmen and the railroads and the logistical folks at the ports and the end users, like that all has to be a really well-oiled machine. And really, when you come down to it, although it's a transaction based supply chain, it's one team. It has to be one team from start to finish, or else that relationship breaks down over time. And when you look at the market from that lens, it makes more sense as to how markets tend to bottom, right? Traders aren't necessarily always the best customers, and they're incredibly active talking to the folks who do physical price assessments for the industry. And the mills, I've learned here pretty recently, are actually pretty quiet because again, they're bound by those contracts, and spot tons really are just traders, a little bit of financial people sort of coming in. So the relationship between, the supplier and the end user is kind of the currency that drives the market forward. And, we'll see it in domestic negotiations where, like a couple of years ago, the steel price was absolutely banging. And, the metallurgical coal price was through the roof and everybody could afford it. So, you could pay whatever it was that you wanted for coke and coal prices. And fast forward to, this last year, that wasn't the case. Steel prices in the US, pardon me, have come down, 65, 70% off peak. And they can't afford to pay what they did, what they agreed to a couple of years ago. And so, that's when the coke and coal suppliers have to work with them a little bit. And then likewise, when the market is really awful, the end users have to make sure that those mines are going to be there the next year and the year after that. So the ones that have the good relationships that with the best qualities, those are the ones that will get, I don't want to say taken care of, but you're going to make sure that those jobs are still there, that you're going to be able to mine coal, you're going to be able to supply it. And that is, that there's one thing, that I've learned from these folks that I admire, is that those human relationships are the most important aspect to, I mean, not just this market, but any market. I guess the short answer is Jim Truman and Dan Horn. But I think like in the course of my career, like that little tidbit of interpersonal relationship knowledge has been more instructive than anything else.
Okay. Yeah, that's interesting. I suppose it's kind of the same in oil and gas. Like when it comes out of the ground, you have to ship it off to somewhere else, and it's no different with coal. Understanding that pipe.
Yeah, I mean, if you're making steel and you need Metcol, like you don't want your suppliers to go out of business. So, and it makes some sense when you sort of think about it like that. And then the closer the relationship is, and the more sort of knowledge is shared between the two, the more navigable these troughs become.
Okay. Sylvia has a question on thermal coal. She says, as the thermal coal price has declined, it seems to have made North America stocks fall a lot harder than the Australian listed ones, which have held up. What does Matt think about this, and does he see some bargains in North America?
Well, I mean, the biggest get there is, well, Newcastle coal has been priced at a premium to European delivered coal for some time. I don't have a chart of European stocks in front of me, but they've begun to come off, and there's been some transactions, but ultimately this is all weather driven and supply driven. And weather for the most part this year has been manageable thus far. We're getting this cold snap across the United States, which has been helpful for natural gas prices. It'll be helpful for spot domestic coal prices, but in Europe, the demand just hasn't manifested in the same sort of way. They're not going through the same wild ass data center build out that we are. And will they eventually? Yeah, I think they probably will. But for now, that demand's been muted. And as I mentioned before, part of the reason the decline in Newcastle's happened is because of those met semi-soft sales getting pushed over by end users or traders into the thermal coal market. But to answer the question, by and large, Newcastle has been more resilient than API2 prices or South African prices.
Okay. Gene wants to know, says, how many thermal coal mines have been approved and come online in the last 3 to 5 years?
Man, that's a hard one. In the United States, I mean, none to speak of. There's always a couple of projects in Canada that get talked about, but none of those have come online. We have the Maxwell mine in Australia that is going to be primarily a semi-soft supplier, I believe, but they're going to produce, 1 million, 2 million tons of thermal coal as well. Uh, but no, I mean, most of the mines that have come on have been thermal byproduct sort of mines, as opposed to, primary thermal coal driven markets. We are seeing, starting to see some increases in Chinese domestic production. Obviously, Mongolia has increased production as well. Some of that is, winds up in the thermal market from time to time. But yeah, no, there just hasn't been much. And to be fair, like, we're not going to see a whole lot of new coal mines built. That's part of the attractiveness of the longer term, value proposition in the sector is, well, demand is falling off less than people think it is, or in fact increasing in some aspects, and yet supply continues to kind of trundle along here. That's in a nutshell the thesis for the long term investment.
Okay. It's got the same question for Metcol. How many Metcol mines have been approved and come online in the last 3 to 5 years?
Okay, well, this one I can answer pretty in a pretty detailed fashion. I'll go ahead and pull up. We on the coaltrader.com Substack, which is the coaltrader.substack.com, I guess. We just put out the first part of our metallurgical coal outlook for 2025. And in it, I talk about the review of 2024, much like we did earlier. And then I start to break down the supply that's coming on here over the next couple of years. In short, we have like 5 or 6 mines. So we have Olive Downs, which is run by a company called Pembroke Resources. They sell basically what's going to be some combination of tier 2 hard coking coal and PCI. So they're kind of a low vol PCI producer, pretty decent hard coking coal. I think last year they produced close to a couple million tons or something like that. This year I have them slotted in for around 4 million tons. And this first phase of development, I think they peak out at around 7 million or 7.5 million. And then they have another phase that they could bring on and take the total capacity up to 15 million. I don't think that's, complete final investment decision's been made on that. Don't want to speak out of turn though. They're still private, but they do some interviews and those sorts of things. And actually, after I talked about them on the Money of Mine podcast last year, they all reached out and said, "Hey, we're hard coking coal. We're not selling any semi-soft." So to be fair, like, guys, we've made that adjustment in our forecast, pulled it over into that category, reduced the amount of PCI. But that is probably the biggest mine that's coming online. It's going to contribute more to supply over the next few years. But again, it's not like super high quality, premium low vol benchmark quality stuff. It's a little bit lower CSR, a little bit lower spec. It's going to fetch, in this market probably about 160 relative to a $190 to $200 PLV price. We also have, I mentioned the Maxwell mine, which is owned by a company called Malabar. That is a kind of high vol B semi-soft coking coal that's also going to produce a little bit of thermal coal. I think capacity on that mine is about 5 million tons. I've assumed that they're going to ramp up from around 1 million tons of semi-soft this year to, I think I have them peaking out at about 3.5 million tons by 2027. The Mammoth underground mine at Coronado, which is located at the Cura complex that they have. That came online, produced a little bit of coal last year. I have them slotted in for about 1.5 million tons going to 2 by 1.5 million this year, going to 2 by 2027. That's also kind of a tier 2 hard coking coal, kind of a tweener, low vol, mid vol. They're probably going to sell some PCI from that as well, sort of similar to what Cura does. Cura in general gets about 80% of the PLV benchmark for Coronado there. We have the Elga mine in Russia, which is a sort of borderline high vol A, high vol B type coal. semi-hard, semi-soft. It's kind of a tweener variation, but a pretty good coking coal. It's sort of interesting because when it gets talked about in research reports or in the press, they're like, this is going to be a 30 million ton a year mine, and they were already at about 24. So the net gain as we head on into 2025 is probably about 6 million tons. But again, it's high vol, it's not premium stuff. In the US, we have Warriors Blue Creek mine, which is a solid high vol A, hard coking coal. I have them slotted in for about 2 million tons this year. We should have longwall production early 2027, and at nameplate capacity, it's going to be about 4.5 to 5 million tons per year. That is short tons, so call it 4 to 4.5 metric or thereabouts. Now for high quality tons, we have Peabody Centurion mine. That's going to be at its peak about 4.5 to 5 million tons a year. That's premium low vol. That's going to get 98, 99% of the benchmark. That is legit strength contributing tons that are coming online. And then Conuma restarted the Tex Quintet mine. And then they acquired the nearby Trend mine, which is also kind of referred to, I think, as Peace River, which used to be owned by Anglo. So that's going to go up to, I think, 4 million tons a year by 2027 or 28. I have it slotted in for about 1.5 this year. So when you add it all up, it's it's about, call it 30 million tons of capacity that increases. But when you just boil it down to hard coking coal, like high quality hard coking coal, you're really only talking about like 13 million tons coming online by the end of the decade. And then when you start to look at depletions, which in Australia is going to be Aquila, Grosvenor, which had the mine fire last year, is out of the market. I think Glencore has 3 mines that are going to deplete. Integra, Okie Creek, maybe just 2 that they have is going to complete. And Hale Creek, I think, is also going to decline. And then Stanmore's Isaac Plains is probably going to deplete by 2035. When you add all that up, you get about 15 to 16 million tons of high quality coal out of the market. So at the same time as this supply is ramping up for high quality tons, you have about an equal amount ramping down. And that's before we get into, are there going to be any further bankruptcies, in the US during this downturn? Companies with really good balance sheets like AMR, HCC, Core Natural Resources will certainly be able to weather the storm, but we're going to have a lot of smaller companies that are less well capitalized that'll fall by the wayside. I think we've had 3 bankruptcies so far in Central App, all small tons, maybe 2 million tons total, not a lot, but we're going to see more of that as time goes on. So in a nutshell, to bring it back, on the Met side, hard coking coal supply kind of balances out. We're getting a lot of semi-soft PCI and filler tons that are coming on, but not a whole lot of tons with strength contributing property, at least on a net basis.
Okay. All right. So 5 to 6 mines coming online. Pembroke, 4 million tons. Malabar, 5 million. Mammoth, 1.5 to 2. Elbini?
Elga.
What's that? Elga. Okay. And that was the Russian one, right?
Yep.
Okay. About 6 million. Blue Creek, 4.5. Peabody's got one for 5 million tons. In Quintet and Peace River, 1.5 to 2, ramping up to like 4. So it sounds like it's kind of balancing out. There's not a whole lot more coming online, which is just kind of underlining the overall thesis that's good for us.
And those depletions are going to take time to play out too. So, we have supply sort of increasing in 25 and 26. And from a cyclical basis, we've known this is coming. Those plans have been in the books for a long time. 2025 was always going to be kind of a down year, I think, for the cycle. Now most of the down part of the cycle has come behind us. but we do have this period of supply rationalization. And I mean, we had a fire at Core Natural Resources near South Mine. It took at least 1.5 million tons out of the market, maybe 3 or 4 if it's down longer than 6 months. So there aren't really any upside surprises at any of the active operations. And if we have, weather in Australia that affects production or, any kind of other downside to supply, well, then these added tons just, are basically a wash. So I would expect PLV to kind of stay in this range we've seen, call it 180 to 220. And that's kind of where we sit for the year. Whereas the relativities for, semi-soft, relativities for PCI, relativities for some of the lower quality U.S. coals may deteriorate a little bit.
Okay. How many tons are we using of met coal as a planet per year, and how many tons are we using of thermal per year about?
Thermal I don't have offhand, but just hard coking coal on the seaborne market, it's about 150 million tons of hard coking coal, and then in total, I don't know, 250 to 300 million in any one given year, depending on how you count certain tons. But that's kind of the market per se. So about half is hard coking coal, and then of that, probably about 30% premium, 25% premium quality, something like that.
Okay, not all met coal is created equal.
Right. On the thermal side, the seaborne number is closer to 1 billion, but I don't know the number right offhand.
Okay. Carson and Vincent have similar questions and basically asking about tariffs. How do you see, we've got a recent changing of the guard. How do you see tariffs affecting different major coal producers in the U.S.?
Good question. It doesn't necessarily depend on our tariffs. It depends on how people respond to our tariffs. So we have two difficulties there as a forecaster, one of which is I don't know what the president's going to do. And I don't know that the president knows what the president's going to do. Sometimes those decisions, as we learned last time, get made at, 6:30 in the morning when he's, angry at something. So it's less about whether or not they're coming. They're coming to some degree. We don't know which countries he's going to target for steel, what, specific types of steel he might target. Like we're talking about putting 25% tariffs on Canada, for God's sake, for, heavier oil specs that we need for refineries in the Gulf. So I don't know exactly what what they're thinking on that side. So how I'm going to approach it is I'm just going to have to react to what happens. Realize that these aren't things that you can necessarily forecast. But you have to be able to kind of run scenarios pretty quickly and see what the knock-on effects are. I would expect to see some sort of steel tariffs on China that should, at least temporarily bolster steel prices in the United States. Or a little incentivize domestic consumption a little bit, but really just tax on, an already kind of, onerous arb spread to bring Asian steel tons into here, unless it's, highly specialized. Tube and pipe, we can always import a little, especially if we're going to drill, baby, drill, and we don't have enough tube and pipe capacity. That's going to have to come from somewhere, probably South Korea. And they might, reprocess Chinese tons that come out on the export market. Who knows? Are they going to tax South Korea for doing that if the feedstock is Chinese? I don't know. How is China going to respond to that? Are they going to tax U.S. Metcol tons? They could. Are they going to tax coke exports, or who knows? I honestly, as soon as I make a prediction, it'll be wrong. So rather than do so, I'd say like this is a year where you just got to keep your head on a swivel. And as those policies come out one by one, we're going to have to go through them and try to take a guess as to how they're going to affect us. And then also on an iterative basis, when other parties don't react the way that we think they might react, if they react irrationally as opposed to rationally, we're going to have to react to that too. So for me, I'm just going to take a deep breath and a big step back and just kind of take it one day at a time and just recognize that in general, there will be additional tariffs. They will be moderately inflationary to the commodity space. I don't think necessarily that it's going to make that big of a difference yet, but I've been wrong about those things before. So take that with a grain of salt.
Okay. I'm going to share my screen here real quick. And last time we were on, so we got the met coal price here. We got thermal coal. What range bound do you see? Like, where should I move these lines as far as a ceiling on thermal, do you think, and a floor on it? What mark would you put those ones on?
Good question. Let me get into our thermal coal forecast here, at least for Newcastle. I kind of think of 115 to 110 as kind of a functional floor.
Okay.
Um, beyond that, you're starting to get into some cost pressures of individual mines. I think upside, we just saw it. I mean, I think 150 is, kind of as good as this market will get,
Okay.
unless we get some help from gas prices.
Okay.
But I think that's a pretty reasonable range to expect. It kind of goes, and just looking there, it goes along with those recent tops back in August and October.
Yeah.
So yeah, call it 110 to 150. Our forecast mostly kind of hangs in the 110 to 120 range for a couple of quarters, and then begins to improve up into like the average basis 120, 125 by the end of the year.
Okay. All right. We'll keep those there. And then what do you see for met?
Net, we're stuck for a little bit until China steel really bounces out. I think from an average standpoint, the 180 to 220 range is hard to get out of until there's either a clear demand increase or alternately some sort of supply rationing, either in at full suppliers themselves, or alternately at Chinese steel plants. So I think getting above 220 is going to be pretty tough. Spot prices always overshoot those numbers.
Yeah.
So, I'm thinking more on an average basis. And 180, when you start to get below 180, especially in the US, there are companies that are smaller independent folks that are going to lose money. We already saw that with Corsa here just a few weeks ago, and that's not something I had on my radar until the middle of the year. I thought they'd struggle in the first half, but given where their costs had been, that they should be able to outlast any problems from a liquidity standpoint. Well, silly us, sure didn't. And I mean, from what I could tell, they only needed about $1.5 million or $2 million to weather the storm, which I'm sure you could have found plenty of people to give them a bridge loan for that. Instead, they filed BK. So if we get some more of those things, that price range might move up. But I think 180 to 220 with the potential for spot prices, for resales or distressed cargoes to tick, the 160 level, maybe even a 150 handle on a temporary basis. But on average, I think we're going to be more like 180 in Q2, and then back to 190-ish Q3, Q4, to 200 depending on where supply comes in.
Okay. All right. 180 to 220 or so. Any updates on AMR?
I mean, none really. We're going to get the final report of the year here in a couple of weeks or so. I would look for them to just kind of keep their heads down and push through. I mean, they're one of the few companies that even at these low prices, their costs are manageable enough at their scale that they can kind of push through, these sort of troughs. I mean, if you think, even if they lose, $5 to $10 a ton, you're only talking about somewhere between 50 to $150 million on a $500 million balance sheet of cash. So they've got room to do, to do as much sustaining capex as they really want, or they feel they need to. If they have any other development projects, they're pretty small that they could bring on. They could. I'm not really looking for them to do honestly much anything except improve the balance sheet as best as they can in this price environment, with an eye to as soon as there's a material change in the direction of met coal prices to they're itching to turn their buyback on and put it to work at lower share prices, but not for a while, I don't think.
Okay. And Vincent and Antonio want to know your view on Ramico Resources. Basically, they got quite a dividend. Thoughts on Ramico?
Well, I mean, they just had to do a financing to make sure they had enough liquidity to pay that dividend. But from an operational perspective, I mean, those mines are great. They're going to be just fine. They got their cost down to about 105, which is fantastic for a Central Appalachian continuous mining operator like that. They have the Berwind mine, which they could ramp up, which is higher quality, low vol. They can, go after domestic contracts in the fall, should they choose to do so. They're going to grow a little bit. I don't know how fast they're going to grow in this environment per se yet. But in general, I look at them and think of that's probably them and AMR have the most juice with regard to if we do get an inflection in coal prices, those are the ones that are going to move faster, especially once we get up over 250. Down here, I think you just have to watch the free cash flow generation, which is, it's probably going to be not much to slightly negative for a lot of Central App operations in Q2, Q3, when the shoulder season kicks in. Right now, I think everybody's kind of modestly profitable. I don't know if it's like, completely offsetting, CapEx, taxes, SG&A, those sorts of things, but it's close. We're pretty close to break even at these levels. So, I think all of these guys are long-term prospects are still good. But we're in this period where, just make a shopping list, make sure you know which ones that you want to buy. And, this Q2, Q3, is a good time to sort of stake some out, and put some in your back pocket that, as long as you're willing to let it sit there and maybe eat glue for 9 months, there's the chances that there's material downside really just lie in, are we going to get a global recession? Or is, China's economy going to completely just, falter and ruin, everyone's, market, globally? I think those are bigger headwinds at this point than coal prices themselves.
Okay. All right. Keep an eye on the world economics. JD wants to know, he says, I'd love to hear Matt's thoughts on Thungela. I don't hear it covered much in podcast space.
Yeah, well, I mean, not much to talk about on the Richards Bay coal prices. I mean, they trade, pretty similarly to API2, and of late they've been much lower. So, usually Richards Bay prices, I think, start to tick up in February. They're about a month off of the cycle for Europe. They're kind of the last ones to react to weather and those sorts of things. But I mean, they're sub $100 right now, and if the coal price is moving in that direction, it's just not. South Africa is not a regime I want really a lot of exposure to at the moment, which is why you haven't heard a whole lot of people talk about Thungela here at this point in time. There certainly is a point. I haven't looked at. Let me pull up the stock price. I haven't looked at the stock price here in a while, but
TGA, right?
yeah.
Okay.
Yeah, I mean, it's from it just made a top here at what was it, 617, and it's sitting at 572 here at this point. So, I think, upside right now is pretty limited. Maybe you get about 10% to the upside, but I think there's downside probably in the mid fours. So there's more downside relative to upside at the moment, especially as we're, heading, starting to head out of winter and into more temperate periods. I'm not looking really at the thermal coal side right now. I do think as far as thermal coal goes, there probably is some interest in domestic U.S. thermal coal going into 26 and 27 after we turn on the LNG export facilities that should be constructed for Henry Hub prices, provided we don't, actually baby drill and go and produce a whole lot of associated gas in the Permian to offset those export numbers. But if we continue down the path where we need 2 or 3% power demand growth for data centers, and we're going to be exporting all these hydrocarbons at the same time, it's hard not to be at least a little bit constructive on the U.S. domestic market relative to the rest of the world. Because the more LNG we export, the more that kind of puts a ceiling on coal prices, at least in the Atlantic Basin. I'm not sure our exports are going to play much in the Japan, Korea, Taiwan, in the Pacific Basin market. So more of an API 2 / Richards Bay sort of dynamic.
Could you go into that a little bit more? So you're saying if we export more,
Yeah,
LN
it's going to go into Europe basically to replace what used to be Russian gas imports. That's where the giant sucking sound is at the moment, and that's part of what's kept TTF prices comparatively elevated to probably where they should be, given where stockpiles are, etc. So as goes TTF, so goes API 2. They're going to move alongside one another. And me not being a weatherman, it's hard for me to take a incredibly constructive view on prices if the gas supply is going to increase. I don't think it's catastrophic. I don't think it's going to collapse or anything like that. But I do think it'll get a little bit looser than it has been recently. And then not much effect, I don't think, in the Pacific Basin. I think that's that price is pretty constructive, and the price range we laid out for Newcastle pretty reasonable.
So you're saying if we export more LNG into the future over to Europe, that thermal coal prices will go up?
No, that just should go down or hold these levels.
Okay. And why would that be?
Well, if gas gets cheaper, that limits the upside for thermal coal because they compete with one another for the same power generation.
Okay. Okay. All right.
Oh, sorry, I thought that was I didn't know which gap I needed to thread there.
Okay. Yeah. You're still talking to a neophyte here. So all of them. Okay. Esprin wants to know about BTU Peabody. Is it now more of a met coal producer with their recent Anglo acquisition?
It is about 75%. I think revenue is going to come from the met coal side now. And I don't know, from a share price perspective, it's been beaten all to hell. And down here sub 20, it's pretty easy to get constructive on it, I think, in the short term. But the bottom line is, I think they for better or for worse, like regardless of what view you take on the Anglo assets, I mean they're kind of middle of the cost curve assets, but the quality of them is absolutely undeniable. So, did they deserve to go from 30 to 1750? No, I don't think so. But you can make the argument that just them, moving from being primarily a thermal producer to a primarily met producer is better for them in the long term, provided they can operate, without incident. North Goonyella, now Centurion, pretty famously caught on fire in 2019, and Grosvenor, which they just acquired as part of this package, also pretty famously caught on fire last end of June. So those seams are pretty gassy, and I don't think that the risk of those types of problems is going to decline necessarily going into the future. I mean, this is now what? I mean, we've had 3 mine fires, all basically very similar. They're all gob fires that got caught at the end of the longwall. You can't really address it. They had to evacuate everybody, put out the fire with with nitrous oxide or nitrogen, and just try to suck all the oxygen out of the fire there and starve it. Seal off the area and then go in to assess damage later. So it's one of those things where I think there's more operating risk there than even the market probably thinks there is. But I'm not sure if it's let's erase half of our market cap value.
Yeah.
Level of downturn. So yeah, I'm constructive on it down here. But I think most of these equities are going to perform right along with coal prices, and it's hard to see coal prices right now getting really off the schneid meaningfully in one direction or the other.
Okay. Okay. Yeah, I tried to catch an option right here. This is only technical. I don't know about, but just a massive triple bottom here, and I literally put the order in at the strike price was I don't remember what the strike. Oh, it was $21, and it was $90 a contract, and then it was 91, 92, 93, and I was just catching it up. I couldn't catch it, and then by the end of the day, I went into the 130s, and I don't know what it is now. I haven't looked, but I'm like, man, it was going up faster than I could click the button to adjust the price.
Yeah, I looked at similar things when it hit there, and I got a lot of emails from people asking about, well, it's stupid down here, right? And yes is the answer, but if there's one thing we learned from the last 6 months, it's that things could get a lot stupider a lot faster than we all think they might. So I've been kind of taking a very patient approach to it. I'm pretty comfortable buying low cost producers a little bit at a time, just when I'm adding to 401ks, but I'm not building up any huge positions here at the moment. I want to see prices get constructive, and if I miss 5 to 10% of an up move, that's really neither here nor there to me. I want to be big for when prices really get going.
Okay. Pondo wants to know, he says, what is your opinion on what's happening with the coking coal relative to the PLV index?
We kind of talked about that to some degree, but coking coal in general, I don't know if he means tier 2 coking coal or PLV is coking coal. So I'm not sure quite where he wants me to drill in on relativity there. I will assume it means the difference between what the PLV index is doing and what other relativities, what other qualities are doing. We talked about PLV, I think basically being stuck between 180 and 220, probably on an average basis for any one given quarter here over the next year at least. But there's been a lot of movement from the PLV market, which, believe it or not, is tight. It's hard to go find PLV cargoes that are fresh. So there's some available like via traders. Sometimes they get sold at distressed cargoes. I've heard ArcelorMittal is trying to place a cargo here right now, but everything else is under contract and is moving according to those. So there's just not really any available. And so for additional strength, the Indians have been buying premium mid-volatile coal. So, instead of a vol content around 20 or 21, talking more like 24, 25%. So lower fixed carbon. And that's getting a premium over PLV right now. So why is that? Well, it's because it's available and that's what people are spending money on. So the spot market is more liquid for that relativity than for others. Now, meanwhile, semi-soft has gotten to the point where, it's got down into the 130s where Newcastle was at 140. And so you got, sales shifted from the met coal market into the thermal coal market a little bit, not in huge quantities, like maybe 5 million tons. But that was enough to kind of sink Newcastle. And it hasn't done anything to improve semi-soft prices at all. They're still around 130. And then when we look at kind of tier 2 hard coking coals and PCIs, they're both kind of hanging in there at this like 155, 160 level, about a 20% discount relative to PLV. And they've just kind of stayed there. They haven't really gone down a whole lot. I think I'd have to pull up what PCI's low price was, but it's not too far below that. For tier 2 hard coking coal and PCI, if you're a steel end user and you want to lower your cost, that's where you have to go. You either have to replace your coke with by injecting coal, you have to inject PCI, or alternately you have to find these sort of less strength contributing coals to fill your coke blend, and then the more that you here's a catch, the more semi-soft and kind of off-spec coals that you use in that blend, the more premium mid-vol and premium low-vol you actually need to offset it. So you have to be careful. It's a balancing act if you're a coke maker, because if you use too much lesser quality, you need to make up for it on the back end somehow, unless you're stamp charging. Stamp charging is like, you have a big lever that comes down and makes like charcoal briquettes, basically. Now, if you're doing that, it doesn't matter so much the quality, but if you're more of a standard oven, man, you really need to look for quality coals. So that's also part of the reason I think we're just stuck here, is that there's very little more that coke makers can do to balance their feedstock. So you'll see these inefficiencies in the market from time to time, where mid vols over low vol, or if there's a couple of trades for U.S. like if you're trying to buy a U.S. cargo right now, there isn't any. There's none available. You can't find a low vol cargo. You can't find a mid vol cargo. So if you have one for sale, is that going to trade at index? No, it's going to trade at something higher than that. And nobody's willing to pull the trigger yet. You have to wait for suppliers or end users, sorry, to become desperate with regards to their stockpiles. They're just not there yet. They'll get there, but not at the moment.
Okay, when I had Warren on the show, he mentioned Colonial coal, and he mentioned they're trying to sell off their assets. Do you have any update on Colonial?
No, I mean, not that I know of. There was some rumor that they were going to get a deal done. The stock price, did pretty well a while ago. I mean, my view on Colonial really hasn't changed. There's great coals, could be a great asset. It's, they just haven't found a buyer. The natural buyer is Glencore. I think Glencore's got their hands full at the moment. I don't think Conuma can get it moving or get it financed or get it through. So, they just really have to sit and wait for the right relationship to come along. And so far that hasn't materialized yet. But I mean, like I said, if you're going to bring on a project like that's, it's a pretty reasonable jurisdiction to bring it on, provided you have the good, First Nations relationships up there, in BC. And we know the quality is going to be pretty darn good because, Tech's been producing up there for years. And even Conuma is even their lower quality assets are still desired in the market. So I'm very constructive on the project. For me, I have to see a path to a sale before I jump in with both hands, which probably means I'll miss it. But I don't really behoove anyone who cares to take a flyer on it. Like I said, great project. It's going to happen at some point in time. But if I were a betting man, I think Crown Mountain comes on before that one does.
Okay. Alrighty. That's it for listener questions. Matt, do you have any final thoughts, any charts you want to share? Anything I should have asked that I didn't?
I mean, no, we kind of went through it all, right? I mean, in the same way that, the last couple of years we've been, harvesting the good prices from the good times. We're now settling back into what is essentially going to be in some kind of equilibrium between supply and demand. And where prices are at the moment, everybody can kind of function. So if the way to solve the problem is to have supply come offline, prices have to get worse. If the way to solve the problem is to have just Indian demand grow, and China thermal coal demand grow, then we need to see that kind of materialize in the market before we get really super excited about a new super cycle on the coal side. So I think we'll see that again in 27. But for the next couple of years, if you're a long-term capital allocator, obviously it doesn't matter. If you're a short-term capital allocator, I think you just need to pay attention to price and momentum, and that's the world we're going to live in for a little bit, which is great. More volatility means traders can make a lot more money, on both the upside and the downside. So, and these markets are, mostly liquid enough to handle, smaller accounts, and there's enough, larger companies to handle, big swaths of capital. So, we're still here. Everybody's still making money to some degree, and, we'll be, it's a pretty, I characterized it the other day. I was like, for being, a bear market, it's not so bad, really. Everybody's kind of making money. They're just not making money hand over fist like they were a couple of years ago. But, 10 years ago, everybody was worried about going bankrupt. And now balance sheets are to the point where, well, they just have to wait it out for a year or two. Very different attitude, and very different mood in the industry now versus, back when I started.
Right on. Well, thank you, Matt. Thank you for coming back on the show. If viewers want to get a hold of you and follow your work, how can they do so?
You can go to the coaltrader.com. and sign up for a premium membership there, or you can visit us over on thecoaltrader.substack.com. Either one, what we publish on one, goes over to the other one. There are some additional, data offerings that we have on the website that we can't really put on Substack. They don't have the infrastructure for it. And we're going to enhance those offerings, I think, over time, and kind of move toward more sell side type coverage as the year goes on. Yeah, the coaltrader.com, thecoaltrader.substack.com. You can follow me, at MF Warder on Twitter, and look forward to talking to all you guys, over the next few months.
Awesome. Right on. Well, thank you, Matt. We'll put all those links down in the show notes below. You have I know you got a heart out. You got to catch a plane. So have a safe flight and a great rest of the day, sir.
Will do, Steve. Thanks for having us on, and great to see you as always.
Yes. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.